You've probably been told your whole life that debt is bad news, that taking out a loan is the fastest way to stay broke. Honestly, I believe that too. It's why I spent years pinching every penny and getting absolutely nowhere. But then I did something everyone I knew called financial suicide. I took out a massive loan. And looking back, that one decision was the single most important step I ever took toward building a seven-figure net worth. Stick with me, and I'll show you exactly how I did it. Section 1. The problem and amp. My old reality. For years, I followed the traditional playbook. I worked my tail off, packed a sad desk lunch every day, skipped the lattes, and religiously moved 10% of every paycheck into a savings account. I was doing everything right, and my net worth was growing at a pace that I can only describe as watching paint dry. I was completely stuck. It felt like I was playing a game that was rigged against me. The whole idea of grinding away for 40 or 50 years to maybe retire comfortably felt less like a dream and more like a trap. I'd see other people making these huge financial leaps, and meanwhile, I was celebrating a few $100 in interest at the end of the year. Whoopee. My entire relationship with money was built on fear. Fear of losing it, fear of not having enough, and most of all, fear of debt. To me, debt was a four-letter word. It meant high-interest credit cards and car payments, a giant anchor dragging you to the bottom. So the idea of willingly taking on more debt? It sounded like complete insanity. I was on the slow, safe path, but it was becoming painfully obvious that the safe path wasn't going to get me the freedom I wanted. It was a path to a life of just enough, and that just wasn't going to work for me. Section 2. The turning point. The billionaire's secret I stole. My big aha moment didn't come from some overpriced weekend seminar. It came when I stopped listening to what people said about money and started watching what the wealthiest people actually did. And I saw a pattern that blew my mind. While I was hoarding every dollar and running from debt, the rich were using it as a tool. They were treating debt like a lever to amplify their own money and control assets way bigger than what they could afford in cash. That's when I finally got the difference between good debt and bad debt. Bad debt was everything I'd always been afraid of. It's when you borrow money for stuff that goes down in value or makes you zero income. Think of a loan for a brand new car that loses thousands the second you drive it off the lot. Or racking up credit card debt for a vacation. That's consumer debt. It makes you poorer because you're just paying interest to make someone else richer. But good debt? That's a whole different ballgame. Good debt is when you borrow money to buy an asset that grows in value, produces income, or ideally, both. This is productive debt. It's an investment. We're talking about a smart student loan for a high-paying career, a loan to start a business you know will be profitable, or the classic example, a mortgage on a property that pays you to own it. That was the mindset shift. Debt isn't good or bad. It's a neutral tool, and its power comes from how you use it. While I was terrified of it, the wealthy were using other people's money to build their fortunes. I decided it was time I learned how to do the same thing. Section 3. My good debt strategy. The first step to $1 million. So, how did I actually do this? I went with the most time-tested strategy out there: real estate. It's a real, tangible thing, and best of all, banks are usually willing to help you buy it. Let me break down my very first deal. I found a duplex for sale at $400,000. Now, the old me would have seen that price and just walked away. The new me asked, okay, how little of my own money do I need to control that whole asset? The answer was the down payment. Lenders for an investment property typically want to see around 20% down. So I put down $80,000, and the bank financed the other $320,000. That's leverage. With my $80,000, I was now in control of a $400,000 property. But here's where the real magic happens, and a quick disclaimer. These numbers were for my market at that time. They will definitely vary for you. The total monthly mortgage payment, with taxes and insurance, was about $2,200. The two units could be rented out for a combined $3,000 a month. You do the math. $3,000 in rent minus $2,200 in expenses left me with $800 of positive cash flow every single month. The property was paying for itself, and then some. The debt wasn't a burden, it was the engine of a cash-producing machine. This one deal unlocked what I call the 4 wealth generators of real estate. Cash flow. That's the $800 a month that went straight into my pocket. Appreciation. While I was collecting rent, the property's value was slowly climbing. Loan paydown. This is the best part. My tenants were paying off my mortgage for me. Every single month, their rent check was reducing my loan and building my equity. Tax benefits. As a real estate investor, you can get some great deductions. Things like mortgage interest and property depreciation can lower your taxable income, though how this works exactly will depend on your own tax situation. I hadn't just bought a duplex. I had bought a system for creating wealth, and it was all kickstarted by a loan. Section 4. The proof. From one loan to a 7-figure net worth. That first property lit the match, but scaling is what started the bonfire. I didn't just take that $800 a month and blow it on fancy dinners. I saved it. A few years went by, and 2 things happened. The property's value went up, and my tenants had paid down a nice chunk of my loan. This created a new pile of money I could use. Equity. My initial $80,000 investment had grown into over $150,000 in equity. So I went back to the bank, took out a loan against that equity, called a HELOC, and used that cash as the down payment for my next property. And then another one after that. All of a sudden, I wasn't just the owner of one asset. I was controlling 3. My cash flow started to snowball, and my net worth started to curve up like a hockey stick. Let's compare that to my old safe path. If I'd just kept my $80,000 in a savings account, it would have barely budged. But by using it as a lever, it controlled a $400,000 asset. My $80,000 was working so much harder, getting 100% of the appreciation on a property I only technically owned 20% of with my own cash. That is the mathematical cheat code that separates savers from investors. My journey to 7 figures wasn't built on saving pennies. It was built on multiplying dollars using calculated debt. Section 5. The reality check. This isn't a get-rich-quick scheme. All right, let's get real for a second. This is not some risk-free, magic bullet path to getting rich. Using debt as a lever magnifies your wins, but it also magnifies your risks. If you're not careful, it can wipe you out just as fast. This whole strategy only works if you follow a few non-negotiable rules. First, you have to buy the right asset at the right price. The numbers have to make sense before you ever sign on the dotted line. The property must have positive cash flow. That means the rent has to cover the mortgage, taxes, insurance, and a buffer for repairs and vacancies. If it doesn't, you haven't bought an asset. You've bought yourself a very expensive problem. Second, you absolutely must have cash reserves. What happens if a tenant leaves and it takes you 2 months to find a new one? Or the furnace dies in the middle of winter? You need a safety net, at least 6 months of expenses to handle these bumps in the road. A lack of reserves is what turns a small issue into a financial catastrophe. And finally, this all has to be built on a solid personal financial foundation. You need a stable income and a good credit score to even get these loans in the first place. This isn't about being reckless, it's about being a disciplined and smart operator. The loan is just a tool. Your financial discipline is the skill you need to use it right. CTA and AMP. Conclusion. The mindset is everything. So, what's the real secret to becoming a millionaire with a loan? It's not a loophole. It's a complete shift in how you think about money. It's about unlearning the idea that all debt is evil and understanding that, when used correctly, it can be the most powerful wealth-building tool you have. The gap between living paycheck to paycheck and building real wealth is often the difference between being a passive saver and being an active investor who gets how leverage works. And this isn't just a strategy for billionaires, it's a repeatable system. So, I want to ask you, what's the biggest thing holding you back from using debt to invest? Drop a comment below and let me know. Is it fear, a lack of knowledge, or the struggle of finding that first deal? And if you're ready to learn how to find and analyze your first cash-flowing property, you're going to want to watch this video right here. It's the perfect next step. And hey, don't forget to subscribe so you don't miss a single strategy on your journey to financial freedom. Thanks for watching.